You are sitting at your kitchen table on the first of the month. Your rent is due. Your car insurance auto drafts today. Your electric bill hits Friday. And somewhere in your brokerage account, a dividend just landed. Except it landed in October. And the next one won't arrive until January. That is how most dividend funds work. Quarterly payments, 4 times a year, completely misaligned with the 12 monthly bills that do not care about your fund's distribution schedule. This is the problem that monthly dividend funds solve. And before you dismiss them as a gimmick, let's run the actual numbers, because the math is more interesting than most people expect. The monthly dividend fund universe is smaller than the quarterly universe, but it is not small. JEPI, the JP Morgan Equity Premium Income ETF, is currently one of the largest actively managed ETFs in existence with over $36 billion in assets. It pays monthly. Its current yield sits around 7 to 8% annually depending on market conditions. Distributed in 12 payments across the year instead of 4. On a $100,000 position, that is roughly $7,000 a year arriving in monthly installments of about $583. Not life-changing on its own. But the mechanism behind how JEPI generates that yield is worth understanding before you buy it, because it is fundamentally different from a traditional dividend fund, and that difference has real consequences. JEPI holds a portfolio of low volatility S&P 500 stocks, but it generates the bulk of its income not from dividends those stocks pay, but from selling covered call options on the index. Every month, the fund sells the right for someone else to buy the index at a certain price. They collect a premium for selling that right. That premium gets distributed to shareholders as income. In a sideways or slightly declining market, this is an excellent strategy. The fund collects option premiums consistently and distributes them monthly. In a strongly rising market, the covered calls cap the fund's upside, because if the market rallies above the strike price, JEPI has to hand over those gains to whoever bought the options. From 2020 through 2023, the S&P 500 had stretches of significant upside, and JEPI lagged the broader index in those periods as a result. From 2022 through early 2023, when the market was flat to declining, JEPI's strategy worked almost perfectly. The fund collected premiums in a choppy market and delivered consistent monthly income while the broader index was struggling. This is the core trade-off with JEPI that nobody explains clearly enough. You are trading some of your long-term capital appreciation potential for consistent monthly income today. If you are 25 years old and 30 years from retirement, that trade-off is probably not worth it. If you are 60 years old and need your portfolio to generate income to cover monthly expenses, that trade-off starts making a lot more sense. JEPQ is JEPI's younger sibling, applying the same covered call strategy to the NASDAQ 100 instead of the S&P 500. It launched in 2022 and has grown to over $20 billion in assets. The yield is similar, currently around 9 to 11% annually, and it also pays monthly. The higher yield reflects the higher volatility of the NASDAQ 100 relative to the broader S&P 500. Higher volatility means option premiums are more expensive, which means the fund collects more premium income when it sells those calls. The trade-off is that JEPQ's income is less stable month to month than JEPI's. In months when the NASDAQ is calm, premiums are lower and the distribution shrinks. In months when the NASDAQ is volatile, premiums spike and the distribution is larger. If you need your monthly income to be predictable to the dollar, JEPQ's variability can be frustrating. If you can tolerate swings in the monthly payment and want higher average income over time, JEPQ has delivered. AGNC is a different animal entirely and worth understanding as a contrast. It is a mortgage REIT, a real estate investment trust that holds mortgage-backed securities and pays monthly dividends. The current yield sits around 14 to 16%, which should immediately trigger your skepticism because yields that high almost always mean something is being given up somewhere. In AGNC's case, what is being given up is share price stability. Over the last 10 years, AGNC's share price has declined from around $25 to around $10. The fund has been paying out high monthly dividends the entire time, but the underlying asset value has been shrinking. If you bought $100,000 of AGNC in 2013 and collected all the dividends without reinvesting, your total return, including those dividends, is roughly break-even or slightly positive depending on the exact dates. Meanwhile, the S&P 500 returned over 200% in the same period. AGNC is not a wealth-building vehicle. It is an income extraction vehicle. And the distinction matters enormously depending on what you are actually trying to accomplish. Main Street Capital is a monthly dividend payer that operates differently from all of the above. It is a business development company, essentially a fund that lends money to and takes equity stakes in small and medium-sized private businesses. Main has paid and increased its monthly dividend every single year since its IPO in 2007, through the 2008 financial crisis, and through COVID. The current yield is around 5.5 to 6%, lower than JEPI or AGC, but the total return picture, including share price appreciation, is dramatically better than either of them. Main stock has appreciated from around $14 at IPO to over $50 today, meaning investors have collected monthly dividends on top of significant capital appreciation rather than instead of it. The trade-off with Main is concentration risk. It is a single company, not a diversified fund, and its performance depends on the management team's ability to pick private companies to lend to and invest in. It has an excellent track record over 17 years, but past performance and active management is always worth examining carefully before assuming it continues. Now let's run the actual income numbers across these options, because that is what makes the monthly structure tangible. Assume you have $250,000 to allocate and you want monthly income. A 100% JEPI allocation at 7. 5% yield generates about $1,563 per month. Consistent, relatively predictable, capped upside. A 100% JEPQ allocation at 10% yield generates about $2,083 per month. Higher income, more variable month to month, more tied to NASDAQ volatility. A 50-50 JEPI and JEPQ split generates about $1,823 per month, with slightly less variability than pure JEPQ and slightly more income than pure JEPI. A split of 60% JEPI, 25% Main, and 15% in a traditional growth fund like SCHD generates roughly $1,400 per month, but adds some dividend growth and capital appreciation potential that the covered call funds sacrifice. The reason the blended approach matters is what happens over 10 years. JEPI and JEPQ are designed primarily for income. Their share prices do not grow the way a growth fund does. If you invest $250,000 in JEPI today, collect the monthly income, and do not reinvest, your $250,000 is still likely to be worth somewhere around $230,000 to $250,000 in 10 years. You will have collected meaningful monthly income the entire time, but your principal will not have compounded. If you invest $250,000 in SCHD and reinvest everything, in 10 years at historical rates, your position could be worth $500,000 to $600,000, but you will have collected significantly less income along the way. The monthly dividend fund investor is choosing income now. The growth fund investor is choosing more income later. Neither choice is wrong. The right answer depends entirely on when you need the money to start working for you. One mechanical advantage of monthly payers that rarely gets discussed is what happens when you reinvest. Dividend reinvestment compounds faster on a monthly schedule than on a quarterly one, because each payment buys new shares that generate their own income 30 days sooner. On a $100,000 position at 7% yield, the difference between monthly and quarterly compounding over 20 years is roughly $8,000 to $12,000 in additional wealth from the same investment. Not dramatic, but real. The practical case for monthly dividend funds comes down to one question. Do you need your portfolio to align with your expense schedule right now? Or are you still in the phase where you are building toward that? If you are building, traditional growth-oriented dividend funds with quarterly payments and reinvestment will likely produce more wealth over a long horizon. If you are at or near the point where the portfolio needs to pay your bills, monthly payers like JEPI, JEPQ, and Main solve a real logistical problem that quarterly funds simply do not. The calendar does not care when your fund's ex-dividend date falls. Your landlord does not accept dividend distribution schedules as a reason for late payment. Monthly income, when you actually need income, is not a gimmick. It is a solution to a problem that every person who ever tried to live off a portfolio will eventually face.